Welcome to episode 7 of Westbrook's COVID Conversations. Joining me today is Estienne De Klerk. Estienne is the CEO of Growthpoint South Africa, and the topic of today's conversation is the impact of COVID-19 on the South African property sector. Estienne, thanks so much for joining us.
Thanks, Dino, for the opportunity.
Maybe before we get into the questions, for those viewers who aren't so familiar with Growthpoint, did a bit of research on the website this morning to give our viewers a bit of background. Growthpoint is South Africa's largest South African primary listed REIT. It's got 568 physical property assets. Pre-COVID, a gross property value of north of 160 billion rand, and a diversified portfolio across retail, office, industrial in South Africa, Poland, Romania, Australia, and the UK. And I suppose for South Africans, quite notably, a 50% interest in the V&A waterfront. Estienne, that's quite a portfolio, and I suppose a challenging thing to manage in the context of COVID-19. How's it gone so far?
Yeah, Dino, I think it's quite unique to have a crisis which actually spreads across your whole business. Now, typically, we diversify locally in the different sectors, but also internationally, and to specifically avoid scenarios where any one sector or any one area can kind of really negatively impact your business. The reality is that the diversification does help, and these kind of crises do show that up. So if you look at our business, our Australian and Eastern European business, as well as our office and industrial business locally, has been, let's say, less affected, whereas everything that's remotely related to retail or tourism is experiencing a really torrid time at the moment.
Estienne, I suppose when you look at a business, you've got various debts you need to pay. You've got to pay your staff, you've got to pay your suppliers, banks, and then the landlord. I suppose on the assumption that everyone wants to pay their staff as an absolute minimum, and the banks are secured lenders, it leaves the landlord and suppliers. How have you found that interaction with tenants over the last few months?
Yeah, so clearly on the retail side, things got a little bit hairy immediately after the announcement of the lockdown. And just as a bit of background, what I did together with a couple of folks in the property industry is we pulled together a group called the Property Industry Group, which is really a lobby group, if you'd like. And it includes SAPOA, SA Reit, which I chair, and the Shopping Centre Council, as well as a whole bunch of other real estate owners across the country. And the initial purpose was just to try and discuss issues that we were dealing with regards to hygiene, keeping our shopping centres open, etc. And then closer to us realizing that the government was going to put the country into lockdown, was negotiating with the government what would be qualifying as essential vis-a-vis non-essential, and all the, let's say, logistics around that. Subsequent to that, we have expanded the working groups dealing with the banks, BASA, the Banking Association, helping the industry to ensure that the banks don't necessarily climb into the different real estate owners' businesses and foreclose on their businesses just because of the fact that we haven't been getting rental. And the issue, dealing with those clients was a big issue because right off the bat, the big 5 clothing retailers put out a public announcement they're not paying any rent, right, or any other utilities or rates, which from a cash flow perspective doesn't matter whether you're the largest real estate owner in the country or whether you're the smallest. It has a particularly negative impact on liquidity. So a big focus for most of the real estate companies have been around liquidity, and these work streams that we put together, unprecedentedly brought the industry together, working together, and I think we've been better as a result. So we've put out a guideline, if you'd like, for our retail clients in terms of assistance. That assistance would be in the form of either discounts, outright discounts for the month of April, maybe even potentially for May, and then stretching into June. And then the big focus there was to try and protect the SMMEs. And the other format of the relief was through deferral of rentals. So those combinations is what we agreed as an industry, and we've categorized our clients, if you'd like, across the different sectors, across those different sectors of retail, and helping them through this time. the reality is that we're in quite a bizarre scenario that you can go and sit in a taxi with 12 people, but you can't sit at a restaurant 3 meters away from somebody else and have something to eat. So we are struggling a little bit to get our mind around some of these rules, and we've been actively engaging government with the same retailers that aren't paying us to try and work together with them to try and get our shopping centers fully open and functional again. So we are in a unique scenario, but yeah, I think we're making progress, and hopefully we're through the worst of it. Clearly it's subject to what government does. And we are trying to encourage them clearly from our point of view that we think that, the shopping center should be fully open. In fact, we believe that some of the measures that they have implemented really has caused a negative impact on social distancing. So usually your population is dispersed in a normal week where people are going to work, and they go and shop in different areas. Whereas at the moment, what's happening is they're all forced into one area, and usually the facilities there cannot cope with the amount of people that are trying to get their goods there.
Estienne, how much longer can we take this? How much longer can the likes of a Growthpoint give discounts, not receive rental income? What does the future hold?
Yeah, so if you look at our business, on the one side, you've got obviously your income, which really broadly is rental, and then recovery of rates, taxes, utilities, and other operating costs from the clients. Now, if that side isn't coming in, it does put a bit of pressure on liquidity, because on the other side, your expenses are pretty sticky. So you've got staff, you've got rates and taxes, which has become a massive problem for the industry. And we have got a working stream that's going to be tackling that with government. And then, utilities and all the, let's call it, other related services, be it hygiene, the cleaning services, security. We've had to beef up security with all our facilities in this period. And so those costs are reasonably sticky. So it's not infinitely possible. I think the industry took a view that we could probably bear the brunt of it for maybe April, May, and to some extent into June. So our relief packages in those 3 kind of months. I think after literally into June, if government doesn't relieve the industry and get businesses back up and running pretty soon, I think that, we into discussions with local government to say, boys, we're not going to pay your rates and taxes this month. And I think that will be a wake-up call for government, because until now, it's been easy to make the rules, but they haven't really had to see the consequences. Whereas, at a local government level, if they're not receiving cash flow, the municipalities are very reliant on the commercial real estate industry for their income.
Estienne, how have the relationships and engagements gone with the banks? Obviously, there is debt in our REIT sector in South Africa. I think with Growthpoint, just under 40% on a loan to value. How have they responded to this?
Yeah, I must admit, I think we've been really amazed and certainly very grateful to our good relationships with the Banking Association, led by now Richard Wainwright. In fact, it was just on the rollover from Mike Brown to Richard, who took over as chairman. And what we have done is we've agreed certain basic principles with them as an industry, which they'll apply then on a case-by-case basis with their clients. And, basically it talks to not calling for valuations, maybe, being a little bit covenant light in terms of their hand in this time. If you think about interest cover ratios and LTV ratios, all those kind of things, are quite important factors. And then providing liquidity to the sector, in the interim, while, cash flow is maybe not perfectly matched with incoming and expenses. So, good progress being made with those discussions. I mean, we have also reached out to ASISA and ASISA's members, and they can be split basically into 2 sections, being the asset managers, of the bond finance and CP finance markets, and then also the life companies, broadly speaking. So those discussions are pretty early days, to be honest. I think we only managed to finally get Competition Commission approval last week to be able to do so. And, we as an industry, we're really concerned for South Africa's corporates just that have bond finance in the bond market. Historically, the bond financiers are a little bit of fair weather friends, but we're hoping that, we as an industry, being reasonably organized, can, convince them to man their corner, maybe even committing to refinancing the finance into the market. I think there's about between 45 and 50 billion rands worth of funding from the bond market into the real estate space alone. And clearly, if you kind of extrapolate that across corporate South Africa, the bond market is quite significant. And if you get a whole bunch of bonds that have to be refinanced, and these financiers are running for the hills, I think there will be a massive systemic liquidity challenge in South Africa, because certainly from the banking perspective, and BASA have made it reasonably clear that they're not going to be a put for the bond market.
Estienne, maybe moving just briefly to the future, I suppose no one has a crystal ball, but any thoughts or views you might have on the longer term impacts on consumer behavior as regards sustainable income and in turn property valuations into the future?
Certainly in the short term, I think that, clearly our economy has been absolutely smashed, right? And that will play out into remuneration levels. It'll play out in people losing their jobs potentially, and that will have a negative impact across South Africa. It doesn't matter what sector you're in. Interestingly enough, over the past month or two, for the first time in probably 5 or 6 years, the office sector has outperformed the other sectors, which is quite amusing, because I think for the past every 6 months I've had to bleat how bad the office sector has been in terms of how tough our economy has been. And you've seen contraction in corporate South Africa over the past 3 to 4 years, which plays out firstly in office and then clearly rolls into all the other sectors. I think tourism will probably be the one sector that's probably going to take the longest to come out of it. And, from the V&A, for instance, being the top performing South African asset, overnight it's the black sheep in the family. And it really has been very hard hit by the tourism sector as well as the lockdown. And that, I think, will take a little bit of a while from an international perspective. I have got, some hope that certainly local tourism will in turn support some of those assets in the future, because people that might have gone to Italy would rather maybe go to Cape Town this year, and to the extent that they can, of course. And so from our point of view, we're lobbying with government to open up that part of the sector pretty quickly. I do think that it'll take a little while maybe for things to normalize, and hopefully the economic effects aren't too material. I think there's varying views on the market, and I think I heard 91's head of SA Investments speak last night on one of the TV shows, and she was calling for I think 10.5% reduction in GDP. Now, that is unbelievable. That's over 550 billion rand or something like that, a contraction. Now, if that is the reality, I think that we're in for a little bit of a hard stretch as South Africans. But we're a resilient bunch, and I think we a lot of our companies are a little bit diversified. So Australia, Eastern Europe certainly helps a Growthpoint. Unfortunately, our UK investment, which is pretty tiny at this stage, clearly being in retail, it's also suffering pretty torrid times in the UK at the moment. So hopefully that also emerges, but that diversification does help a little bit in that sense.
Estienne, one last question, if you don't mind, maybe less applicable to Growthpoint and more to the sector. From a REIT compliance perspective, obviously you are subject to certain rules. The most notable of which are that you need to pay out 75% of your taxable income to shareholders each year, and that their maximum loan-to-value ratio is of 60%. I suppose the real question that bodes now with COVID is, To the extent that REITs, for whatever reason, choose to skip dividends, or to the extent that cap rates push out and income reduces, loans to value go up, have you had any engagement with the various regulators around these issues and what it might mean for the REIT sector going forward?
Sure. So, Dino, one of the PI group work streams was the SA REIT Association's Tax and Regulatory Committee have approached the JSE as well as National Treasury. And what we have asked for is a temporary relief from a regulatory perspective in order to really allow REITs to retain their distributions on the one hand, and then obviously, get relief for things like LTV to the extent and that becomes applicable. The sector is reasonably lowly geared, so I would suggest that generally, I don't think that these companies will hit those covenants, but to the extent that you don't have access to additional debt in the debt markets, you're not getting all your rent, and the equity markets, certainly for the time being, I think might be open, but are pretty thin in terms of raising capital. And to the extent that you can raise capital, it'll be very, very expensive and very dilutive. The best way for these companies to remain sustainable is to be able to withhold a little bit of their income. Now, as you will be aware, in terms of the REIT legislation, REITs have got the obligation to pay out at least 75% of their taxable income. And to the extent that they withhold income, that's taxed like a normal company would be. So what we have asked for is a bit of relief on withholding. So in other words, let's say temporary relief on the 75%, maybe reducing it to either 0 or maybe 25% or something to that effect. And that will give the companies the ability to do so. In that process, the JSE will not put them in breach in terms of their REIT legislation and regulations. And then furthermore, there were certain little tweaks needed in terms of the rental rule. So in the REITs, you have to have 75% of your income coming from rental as defined. And there are certain companies that have entered into cross-currency swaps and earn other income. And with the rental dropping temporarily, there was a risk that maybe these guys blow out on some of those covenants. So the JSE have been unbelievable. They really have come to the party, and they've certainly given us as an industry certain undertakings that they on a case-by-case basis will deal with each company. And it's not their intention to breach any of the REITs. And then National Treasury have actually responded to say that they will consider our application, and they've asked for some additional information, which we're in the process of providing them. That process probably will take a couple of months, I must point out, though.
Estienne, thank you so much for the time. I suppose it's not easy to be a landlord during COVID-19, but a real privilege to learn a little bit more around how Growthpoint is navigating things. We really appreciate the time.
Thanks, Dino. All the best to you guys.
That's Estienne De Klerk. He's the Chief Executive Officer of Growthpoint South Africa on today's COVID Conversations.